Hello and welcome to this new edition of our investment strategy series. 7 months into the pandemic, the global economy has made a very substantial recovery from the deepest recession in history, with the help of massive fiscal and monetary support. Thankfully, the worst of the crisis is now behind us. But unfortunately, so is the best of the recovery. Indeed, it's clear that a return to normality will take time. Growth is inevitably slowing as economies are only running at 90% of their pre-pandemic activity. And a full recovery is not possible until a vaccine is widely available. Until then, we face more unemployment uncertainty, and we will rely on central banks and governments around the world to keep supporting households, companies, and financial conditions. Still, the world is in a better position to manage the health crisis. Indeed, hospital capacity and test and trace systems have improved, and authorities have shifted from full-scale confinements to more locally targeted measures. Renewed lockdowns are therefore unlikely, and recent vaccine developments have been encouraging. All this is crucial for the still precarious economic revival. Overall, we expect the pandemic to drive the economic outlook, delivering a slow but gradual recovery backed by vital policy support. So let's hear now from Stéphane how investors can shape their portfolios in this environment.
As Samy just explained, the pandemic and support from central banks and governments have redefined the investment landscape. And we have already positioned our clients' portfolios for the opportunities of the post-COVID-19 world, without compromising on quality or risk. We see value in several areas that can produce attractive returns in the coming years. Firstly, China deserves to have its own portfolio allocation. The country has come out of the crisis more robust than many others. More importantly, China is reshaping its economy and strategically positioning itself for global leadership. We have to ensure that our clients' portfolios can capture the value creation underway in the world's second largest economy. Secondly, it's essential to have exposures to global trends that are transforming our societies and economies, such as climate change, digitalization, and demographic evolutions. Thirdly, private markets will play a larger role in portfolios, offering additional value to long-term investors. And finally, gold and real estate have become strategic portfolio components. While real estate can help capture more yield, gold enhances diversification and acts as a portfolio hedge. Our strategic asset allocation now reflects the new long-term economic and geopolitical dynamics. In the near term, we believe we are well positioned to navigate the road ahead with a reduced exposure to equities and rate-sensitive assets. As Samy highlighted, the virus remains key to the path to recovery, and several risks must be closely watched, namely any monetary or fiscal policy mistakes that could slow or even stop the recovery, tensions between the US and China, and crucially, the US presidential election in November. To manage the volatility in the coming months, we continue to hold portfolio protection in the form of gold and the yen, and enough liquid assets to seize tactical opportunities as they arise. The virus is not going away soon, and the recovery won't accelerate until it does. In this 90% economy, we continue to build resilient portfolios by carefully allocating capital to help our clients access the investments, trends, and technologies that are shaping our future. Thank you very much for watching.